Picture this. August 1998. You're a hedge fund manager in Connecticut. Your portfolio is up 40% year to date. You're crushing the market. Then Russia defaults on its debt, a country 6,000 miles away that represents 2% of global GDP. Irrelevant, you think. Within 48 hours, your fund loses 44% of its value. Not over months, in 2 days. Long-term capital management, run by Nobel Prize winners, collapses. The Federal Reserve has to orchestrate a $3.6 billion bailout to prevent global financial system meltdown. A currency crisis in Moscow nearly destroyed Wall Street. That's not correlation. That's contagion. Fast forward to today, January 2026, the Turkish lira has lost 87% of its value since 2018. The Argentine peso lost 95% since 2018. The Egyptian pound crashed 70% in 2 years. Lebanon's pound lost 98% of its value. These aren't small emerging markets anymore. These are systemic fractures spreading through the global financial system. And here's what should terrify you. Your 401k, your retirement account, your stock portfolio, they're all connected to these currency crises in ways you don't understand. When currencies collapse in Turkey, Egypt, Argentina, the shockwaves hit your investments, whether you know it or not. Before we dive into how currency crises are reshaping every investment you own, from stocks to bonds to real estate to crypto, hit that subscribe button and join the Wealth Forum. This is the global financial architecture collapsing in real time, and your wealth is caught in the wreckage. It's free. Unlike the price, you'll pay for not understanding how currency risk is eating your portfolio alive. So here's the question that changes everything. If currencies are collapsing around the world, can your investments survive? Or are you holding assets denominated in dying money? Stick with me. Let me show you the historical pattern that repeats over and over. Currency crises don't stay contained. They spread, they mutate, they destroy wealth in unexpected places. 1994, Mexico's peso crisis. The peso lost 50% of its value in weeks. US investors holding Mexican stocks and bonds were annihilated. But it didn't stop there. The tequila crisis spread to Argentina, Brazil, and Southeast Asia. Investors fled all emerging markets, even safe assets in stable countries, sold off because of contagion from one currency collapse. 1997, the Asian financial crisis started in Thailand when the baht collapsed, spread to Indonesia, South Korea, Malaysia, Philippines. Within months, $600 billion in market value evaporated. The crisis reached Russia by 1998, causing the default that nearly killed long-term capital management. Then it spread to Brazil in 1999. One currency collapse in Bangkok triggered a global chain reaction that lasted 3 years and destroyed trillions in wealth. Year 2001, Argentina defaulted on $132 billion in debt. The peso, pegged at 1-to-1 with the dollar, collapsed. Argentines who thought their savings were safe in dollar-pegged accounts lost 75% of their purchasing power overnight. The crisis spread to Uruguay, Paraguay, and weakened Brazil's currency again. Here's the pattern. Currency crises start local. They go global. They destroy wealth indiscriminately. And here's the analogy that explains this. Think of the global financial system as a network of dominoes standing in a circle. Each domino is a currency. When one falls, it doesn't just knock over the domino next to it. The shockwave travels through the entire circle. Sometimes dominoes on the opposite side fall before the ones in between. That's currency contagion. And right now, in January 2026, we're watching dominoes fall in real time. Turkey's lira lost 87% since 2018, from 3.6 lira per dollar to 9.x lira per dollar. Argentina's peso lost 95% since 2018, from 20 pesos per dollar to over 800 pesos per dollar. Egypt's pound crashed 70%, from 15.7 per dollar to over 50 per dollar. Lebanon's pound went from 1,507 per dollar to 80,500, a 98% collapse. These aren't isolated events. These are connected fractures in a system under stress, and the stress is about to break something much bigger. Let me explain exactly how currency crises destroy your investments, even when you think you're diversified. Mechanism 1. Direct currency exposure. This is obvious, but most people don't realize how exposed they are. If you own stocks in a foreign company, you have currency risk. Let's say you buy shares in a Turkish company in January 2024. The stock price in Turkish lira stays exactly the same over 2 years, but the lira loses 30% against the dollar. Your investment, when converted back to dollars, is down 30%, even though the stock price didn't fall. Most international mutual funds and ETFs have this exposure. If 40% of your portfolio is in international stocks, and those currencies fall 20% against the dollar, you've lost 8% of your total portfolio value from currency moves alone. That's before any stock price changes. Mechanism 2. Indirect currency exposure through commodity prices. When emerging market currencies collapse, those countries become desperate for hard currency. They dump commodities, gold, oil, copper, anything they can sell for dollars. That floods commodity markets, driving prices down. If you own commodity stocks, mining companies, energy companies, your holdings get hit twice. Once from falling commodity prices, again from the currency of the country where those companies operate. Mechanism 3. Credit contagion. When a country's currency collapses, its ability to service dollar-denominated debt evaporates. Turkey has $450 billion in foreign currency debt. When the lira collapses, that debt becomes insurmountable. Companies default. Banks holding that debt take losses. International banks with exposure to Turkish debt see their stock prices fall. If you own shares in JP Morgan, Citigroup, HSBC, you have exposure to emerging market debt. When those debts default, your bank stocks fall, even though you never invested in Turkey directly. Mechanism 4. Trade disruption. Currency crises destroy purchasing power in the affected countries. A Turkish citizen who could afford an iPhone in 2018 cannot afford one in 2026. Because the lira collapsed, Apple's sales in Turkey evaporate. Same for every US company that sells products there. If 15% of a company's revenue comes from emerging markets experiencing currency crises, and those markets suddenly can't afford their products, earnings fall 15%. The stock falls. Your portfolio falls. Mechanism 5. Capital flight and safe haven flows. When currencies collapse, investors panic. They sell everything in affected countries and buy perceived safe havens. That means selling stocks, bonds, real estate in crisis countries and buying US treasuries, gold, Swiss francs, Bitcoin. This creates artificial demand for safe haven assets, driving their prices up beyond fundamental value. If you're buying those assets at inflated prices thinking you're safe, you're setting yourself up for losses when the panic subsides and prices normalize. Mechanism 6. Interest rate shocks. When a currency collapses, the central bank typically raises interest rates aggressively to defend the currency. Turkey's central bank raised rates to 50% in 2023. Argentina's to 133% in 2023. Egypt's to 25% in 2024. High interest rates crush economic growth. They cause recessions. Stock markets in those countries collapse. If you have any exposure, direct or indirect, you lose. But here's the global mechanism most people miss. When emerging markets raise rates to 50%, 100%, 133%, and the US offers 4.5%, capital floods out of the US into those high-yielding markets. That puts downward pressure on the dollar. A weaker dollar makes US exports more competitive, but it also makes imports more expensive, driving US inflation. The Federal Reserve is then forced to raise US rates to combat inflation and support the dollar. Higher US rates crash US stocks and bonds. Your domestic portfolio gets hit because of currency crises happening in Turkey, Argentina, and Egypt. 6 mechanisms, all interconnected, all capable of destroying your wealth. And all of them are active right now in January 2026. Now let me show you the exact moment we crossed from currency weakness to currency crisis, and why your investments are at risk right now. November 2024, Argentina elects Javier Milei, a radical libertarian who promises to dollarize the economy. The peso collapses 54% in December 2024 alone. Capital controls are imposed. Foreign investors holding Argentine bonds lose access to their money. 65 billion in foreign reserves evaporate as the country tries to defend the currency. By January 2025, Argentina's inflation hits 211% annually. The peso is trading at 850 per dollar. Poverty rate hits 57%. Social unrest erupts. Then February 2025, Turkey's central bank is forced to cut interest rates, despite 65% inflation because the economy is contracting 3.2% annually. The lira falls 18% in 1 month. Foreign investors holding Turkish stocks lose 18% from currency alone, plus another 12% from falling stock prices. A 30% loss in 30 days. March 2025, Egypt devalues the pound for the 4th time in 2 years. The pound goes from 30 per dollar to 50 per dollar overnight. A 40% devaluation. The IMF demands it as a condition for a bailout. Egyptian citizens riot. The government imposes capital controls. Foreign investors are trapped. These 3 crises, Argentina, Turkey, Egypt, together represent 3.2 trillion in GDP. That's larger than the UK economy. And all 3 are melting down simultaneously. But here's where it gets dangerous. These three countries owe $890 billion in foreign currency debt combined. Most of that is owed to international banks. JP Morgan has $12 billion in exposure. Citigroup has $18 billion. HSBC has $22 billion. BNP Paribas has $15 billion. When these countries can't pay, those banks take losses. When banks take losses, they cut lending. When they cut lending, economic growth slows everywhere. That's how a crisis in Cairo affects your portfolio in Cleveland. April 2025, Pakistan's rupee collapses, 35% in 6 weeks. The country is on the brink of default. Bangladesh taka falls 22%. Nigeria naira falls 45%. Sri Lanka, still recovering from its 2022 default, sees its rupee fall another 30%. By June 2025, 12 emerging market currencies are in crisis, not weakness, crisis, defined as losses exceeding 20% in 6 months with capital controls or default risk. And then comes the revelation that changes everything. July 2025, the Bank for International Settlements releases a report showing that global banks have $4.2 trillion in exposure to emerging market debt. That's 8% of the entire global banking system's assets. If 25% of that debt defaults, that's a $1 trillion hole in the global banking system. Banks become insolvent. Credit markets freeze. We're looking at 2008 all over again, but triggered by currency crises instead of housing. August 2025, the MSCI Emerging Markets Index falls, 23% in dollar terms. But for investors in those countries, it's worse. Turkish stocks fall 47% in dollar terms because the lira fell 30% and stocks fell 24% in lira. Argentine stocks fall 61% in dollar terms. If you held a diversified global portfolio with 30% in emerging markets, you just lost 13.8% of your total portfolio value in 2 months. That's not a correction, that's a crisis. September 2025, China, watching the chaos, accelerates de-dollarization. They announced the digital yuan will be used for 40% of Belt and Road Initiative trade by 2026. They're building infrastructure to bypass the dollar because they see what dollar-denominated debt did to Turkey, Argentina, and Egypt. This accelerates dollar weakness. The dollar index falls from 101.5 in September 2025 to 98.5 by January 2026, a 3% decline in 4 months. That's a $850 billion reduction in dollar-denominated asset value globally. October 2025, the IMF warns that 15 countries are at high risk of debt distress. That's $6.7 trillion in GDP at risk. The World Bank warns that currency crises could trigger a global recession in 2026-2027. November 2025, US corporate earnings reports start showing the impact. Apple reports revenue down 12% in emerging markets. Nike down 18%. Tesla down 22%, McDonald's down 9%. Every US multinational with significant emerging market exposure misses earnings. The S&P 500 falls 8% in November 2025. As investors realize, currency crises are affecting domestic earnings. Your US stock portfolio is getting hit by events in Turkey and Argentina. December 2025, high-yield emerging market bonds, which yield 12–15% and were considered safe diversification, start defaulting. Zambia defaults. Ethiopia defaults. El Salvador suspends payments. Pakistan enters restructuring talks. If you own emerging market bond funds in your portfolio, you're seeing 15–25% losses. Funds like EMB, Emerging Market Bond ETF, are down 22% in 2025. It's like investors who thought they were getting safe. 12% yields are losing 20% in capital. And then January 2026, the revelation. A leaked document from the IMF shows that they're preparing emergency facilities totaling $850 billion for currency crisis bailouts in 2026. That's more than double the usual annual lending capacity. The IMF knows something catastrophic is coming, and they're preparing for it. But $850 billion isn't enough if multiple G20 countries face crises. Japan's debt is 264% of GDP. Italy's is 144%. The US is 123%. If any of these face currency crises, there's no bailout big enough. This is the moment. January 2026. We're not headed toward a currency crisis. We're in one, and it's spreading from emerging markets to developed markets. Now let me show you how this currency crisis is reshaping every investment category you own. Consequence 1. Stocks are repricing currency risk. Historically, investors priced stocks based on earnings growth, competitive advantages, management quality. Currency risk was an afterthought. Not anymore. In January 2026, The correlation between stock prices and currency strength is U78. That's the highest correlation since 1998, meaning 78% of a stock's performance is explained by currency moves, not business fundamentals. If you own Apple, 65% of revenue comes from outside the US. If those currencies weaken 10% against the dollar, Apple's revenue falls 6.5% even if unit sales stay constant. The stock reprices accordingly. Consequence 2. Bonds are becoming currency bets. Emerging market bonds yielding 12-15% look attractive until you realize the currencies will likely fall 20-30%. Your real return is -8% to -18%. US Treasury bonds are considered safe, but if the dollar weakens 5% annually due to global de-dollarization, your 4.3% yield becomes a -0.7% real return when adjusted for currency depreciation against a basket of other currencies. Consequence 3. Real estate is localizing. International real estate investment is collapsing. Why buy property in Turkey when the lira might fall another 40%? Foreign direct investment in emerging markets fell 34%. In 2025, capital is staying home. That means less liquidity, lower prices, and trapped capital for anyone who bought international real estate in the past decade. Consequence 4. Commodities are becoming volatility machines. When currencies collapse, commodity exports surge as countries desperately sell anything for hard currency. That crashes prices. Then central banks raise rates, causing recessions, further reducing commodity demand, further crashing prices. Oil fell from $95 per barrel in April 2025 to $71 by January 2026. Despite Middle East tensions, copper fell 23% in 2025. These are not supply-demand fundamentals. These are currency crisis dynamics. Consequence 5. Crypto is emerging as a crisis hedge. Bitcoin hit $108,000 in January 2026, partly because Turks, Argentines, Egyptians, and Lebanese are buying it as an escape from currency collapse. Trading volumes in crisis countries are up 340% in 2025. But this creates a new risk. If governments start banning crypto to prevent capital flight, the correlation breaks. Argentina already restricted crypto purchases in December 2025. Turkey is considering it. Consequence 6. Portfolio diversification is dead. The old model was 60% stocks, 40% bonds, diversified globally. That model assumed low correlation between assets. Currency crises create correlation of 0.8 plus across all assets. Everything falls together. In 2025, the 60-40 portfolio returned -4.2%. International diversification made it worse, not better. Investors lost money in supposedly safe, diversified portfolios because currency crises hit everything simultaneously. Consequence 7. Safe havens are overvalued. The flight to safety has driven Swiss francs, gold, and US Treasuries to extreme valuations. Gold at $5,000 per ounce prices in permanent currency collapse. If the crisis stabilizes, gold could fall 30-40%. Swiss franc is overvalued by 28% based on purchasing power parity. Treasuries are yielding 4.3% with inflation at 3.1%. A real yield of only 1.2%, barely above zero. Investors fleeing currency crises are paying premium prices for safety. When the panic subsides, those safe havens will reprice lower. Consequence 8. The next crisis will be bigger. We've had currency crises in countries representing $3.2 trillion in GDP. If the pattern spreads to Japan, $4.2 trillion GDP, Italy, $2.1 trillion GDP, or China, $17.7 trillion GDP, we're looking at a systemic global crisis that makes 2008 look small. Currency crises are reshaping your investments, whether you acknowledge it or not. The question isn't whether you're exposed. You are. The question is whether you understand your exposure and are positioned to survive it. So here's the brutal truth. Currency crises are not anomalies. They're features of the global fiat currency system. Since 1971, when the gold standard ended, there have been 147 currency crises worldwide. That's an average of 3 per year for 53 years. Your investments have always been shaped by currency crises. You just didn't notice because they happened in small countries far away. Argentina in 2001, Iceland in 2008, Greece in 2012. Each time, you could ignore it because it didn't affect you directly. But 2025-2026 is different. The crises are bigger. Turkey is a G20 nation. Argentina is the third largest economy in Latin America. Egypt is the most populous Arab nation. These aren't peripheral economies anymore. And the crises are synchronized. 12 countries in crisis simultaneously. That hasn't happened since 1997-1998. The global financial system isn't built to handle this. Here's the lesson most investors won't learn until it's too late. Geography doesn't protect you. Buying only US stocks doesn't protect you when 40% of S&P 500 revenue comes from overseas and currency crises destroy that revenue. Diversification doesn't protect you when currency crises create 0.8 plus correlation across all asset classes. Everything falls together. Safe havens don't protect you when everyone is fleeing to the same safe havens simultaneously, driving them to overvalued levels that will eventually correct. The only protection is understanding. Understanding that currency is the foundation beneath every investment. When that foundation cracks, everything built on it cracks too. And right now, the foundation is cracking in 12 countries. The cracks are spreading, and your portfolio is built on that cracking foundation, whether you realize it or not. So what do you do? First, acknowledge currency risk exists in your portfolio. If you own international stocks, international bonds, commodities, or US multinationals, you have currency exposure. Second, understand your exposure. What percentage of your portfolio is vulnerable to emerging market currency collapse? What percentage is vulnerable to dollar weakness? Calculate it. Third, hedge strategically, not necessarily with complex derivatives, but through allocation. Hold some assets that benefit from dollar weakness, like gold. Hold some that benefit from dollar strength, like US government bonds. Don't be concentrated in one currency outcome. Fourth, accept that traditional diversification is broken. The 60-40 portfolio lost money in 2025. The model assumed low correlation. Currency crises destroyed that assumption. Build portfolios designed for high correlation environments. Fifth, monitor the warning signs. When emerging market currencies fall 20% plus in 6 months, that's a warning. When foreign currency debt exceeds 60% of GDP, that's a warning. When capital controls get imposed, that's a warning. These warnings are flashing red right now. The currency crisis of 2025-2026 is reshaping investments in real time. Your stocks are repricing for currency risk. Your bonds are becoming currency bets. Your diversification is correlating to 0.8 plus. Your safe havens are overvalued. The question isn't whether currency crises will affect your investments. They already are. The question is whether you'll adapt or be destroyed. If this analysis showed you the invisible currency risk destroying your portfolio, smash that like button, subscribe to the Wealth Forum, and turn on notifications so you understand every stage of this global currency crisis as it unfolds. Now here's my question for you. What percentage of your portfolio do you estimate has emerging market currency exposure? Drop your number in the comments. 10%? 30%? 50%? Or do you have no idea? Tell me if you've calculated your currency risk, or if this video made you realize you need to. Are you hedged for this crisis or fully exposed? I read every single comment. This community is learning together. And remember, currency crises don't announce themselves with sirens and flashing lights. They happen quietly, gradually, then suddenly. By the time it's obvious, your portfolio has already lost 20-40% from currency moves you didn't see coming. The smart money calculated their currency exposure in 2024 and repositioned. The aware money is calculating now. The unaware money will realize too late that their diversified portfolio was actually concentrated currency risk that blew up when the crises spread. Which category will you be in?